purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll take a look at the major equity indices as they currently stand. Things are improving a little bit. They're not quite there yet, but we are certainly seeing some improvements to the quality of the equity rally that we are currently in. Not a whole lot has changed in the fixed income market. So we'll take a look at the overall trends just to see, where the consolidation may resolve themselves. We'll take a look at some of the major commodities as they are trading near some major resistance levels and what that means for those commodities, and then show you the sector rotation model with which sectors are leading, which sectors are lagging behind before looking at some of the stocks that are breaking out in this market, as well as some of the stocks that are breaking down in this market. So when we start off with the S&P 500, it remains on its strong bullish trend. No doubt about that. Yesterday making a new all-time high as it continues on the slow grind higher. And it's exactly that. It's a slow grind higher. The higher highs in momentum here yesterday was not confirmed by momentum. So we're continuing to see the same market action as we've seen here over the past few months, where we just have slow grinds higher followed by small pullbacks here, as we've seen multiple times, small pullbacks that are quickly, reversed higher as they continue to march higher after these pullbacks. So that's the market that we are in right now. The S&P 500, not particularly healthy, but also, just continuing what we've seen here. The NASDAQ 100, similar price action, new all-time high here on the NASDAQ 100. Momentum did confirm that new high here. So at least you have a little bit of strength here in the technology stocks versus the broad-based mega cap stocks. And then when we look at the Russell 2000 small caps, showing some strength here after what looked like a pretty weak showing from the past couple of weeks. We're starting to see some broader participation from the small cap stocks. Certainly still nowhere near its real all-time highs, but certainly improving back towards the 235 levels here. If we can break out above 235, that certainly puts the broader markets intact with the broader equities that were the broader rally that we've seen here on the mega cap indices. And then when we look at RSP, the equal weight S&P 500 index, it did not make a new high yesterday, but it is trading at relative all-time highs, meaning market breadth is improving, that there is more participation here in the broader markets on these rallies. That is improving. It's not quite where we would like it to be. And I have another chart to show you just exactly where we are, but things are slowly improving. And that's at least moving in the right direction here right now for the equity markets. And then when we look at emerging markets, EEM trading just near this major support and resistance level that we have mentioned here over the past couple of weeks. Now, the question is, does it get rejected at this level and continue to move lower and remains in this kind of downtrend here? Or does it start to break out above this downtrend and start to show some participation? That's going to also help shape our views here in the equity markets as to how international and emerging markets are shaping up. They haven't been performing very well over the past couple of months, but perhaps we're starting to see some of that improve here. So this is one that we're going to pay attention to here over the next couple of months. But the chart that I really wanted to show you here is the number of stocks that are above its 50-day moving average. This number has improved significantly here over the past few weeks, but it still only sits at 51%. Only half of the stocks are participating in the equity rally that we're seeing. That is an improvement, but that is not quite where we would like it to be for equity markets to trade at new all-time highs. So if this continues to improve, that will provide further support here for the equity markets as a whole. But if we start to see this get back into the 30-40% range, that's really where we start to have some challenges to how much further this equity market can run. And then when we look at the bond market, so far bonds holding fairly well here to this move here. As you can see, after this big move here in TLT, we continue to consolidate here, but so far holding this level here, this could very well break out here to the upside and the bond rally can continue. That's going to send bond yields lower. That's going to send likely equity or support the equity valuations that they are currently trading at. So far, there's no evidence that this is not going to continue in this particular direction at the moment. If we start to break below 146 or so, that's when we can start potentially seeing yields rise. But until that happens, I think the base case is still that yields will remain where they are and likely can continue to grind even lower from here. When we look at the dollar index, the $93 level so far has been rejected. We have not seen a significant move here above 93, but so far the overall trend still remains somewhat here to the upside. So this very well could make a new move back up toward that 93 and potentially break out even further. But so far, we haven't seen that momentum. We haven't seen the breakout here, but this is one that we're going to pay attention to. As we start to break below 92 or so, that's when we would say dollar index is very much just range bound rather than continuing on this uptrend. But so far, things look like it can continue moving up and test that $93 level. When we look at gold, gold so far has held this 200-day moving average. The 200-day moving average has held as resistance. If we can break above this 200-day moving average, which it has been trying here for the past few days, that's really where we start to put 179, 180 into contention. And that is going to start putting this longer term downtrend potentially at risk of breaking out higher here. So right now we're not there yet, but, we have seen this bottoming formation so far hold. It is now testing the 200-day moving average multiple times. If we start to break out above the 200-day moving average, that would put this, they only have one minor level of resistance here around 171. And if it breaks out above that, we're really looking at 179, 180. And if we can get back up to the 179, 180 level, that certainly starts to complete a bottoming formation here that would then start putting gold back into the 196, 197 level here to the upside. So this is a level that I think we need to start paying attention to here in gold as it continues, as it no longer really makes any lower lows. It's actually making higher lows, and all we need to now see is higher highs for gold to start breaking higher here. So a lot of interest right now in terms of gold, Bitcoin, and just general assets that are kind of inflationary hedges. So this is one that I think is worth paying attention to for these key levels that we are starting to see form in gold. And then when we look at the 10-year yields, the downtrend remains intact, and that is still going to be our base case. That 10-year yields will likely remain range-bound and test perhaps to the lower end of the range unless we can see a meaningful break above this trend line. And this is what we're seeing here in bonds also, that 146 level on TLT. Until we see bonds break below those levels, our base case remains that yields will likely to continue compressing to the downside. And as long as yields continue to compress to the downside, we will remain in the slow grind higher here that we see in equities, despite the fact that things don't look particularly healthy for the equity market rally, because these things can continue to go on for quite a long period of time before things kind of break, if you will. But that's the market that we're currently trading in right now. And then when we look at crude, recently breaking below the $66 level that we referred to, this was a key level here for crude, as it has spent many months either using this level either as resistance or support. We finally broke below it last week, but because of the hurricane and some of the supply concerns, oil rallied back above this level. But what is interesting to see is that despite that, oil was not able to make it back above its recent highs around 70. That means that this downtrend remains intact. And I think that you're likely to see oil kind of start rolling over again back towards the $62 level here or so, and perhaps retest the $62 level, and which also corresponds roughly with the 200-day moving average. Might find a little bit of support here around the 200-day moving average, but if we break below the 200-day moving average, that's when you can see some significant downside here for crude. So these are some important levels to pay attention to as crude kind of finds its equilibrium around 65, 66 or so. It's likely going to oscillate perhaps around the $66 level, but if it breaks below that 200-day, that's really where some downside could come in for crude. And then when we look at sector rotation, this is really where Sector rotation, there's a little bit of rotation here right now, but it's not particularly healthy. You have 3 sectors in improving and leading, and you have 8 sectors in lagging or weakening. So the vast majority of sectors are not advancing. They're actually falling behind the broader market. So if we look at the leading category, you have technology that has recently entered the leading category here for about 4 days or so. That's the only sector that's currently leading. And then when you look at the weakening category, you have 4 sectors: healthcare, utilities, financials, and materials, all losing momentum, all losing relative strength. Recently, these were all the sectors that were leading that are now in the weakening category. And then you have quite a few sectors that were either improving or leading that are now in the lagging category. You have consumer staples and you have industrials that are losing both momentum and relative strength. You do have discretionary and energy moving back towards the improving, but they're still currently in the lagging category. And lastly, in the improving category, you have real estate and you have communications, both of which seem just fairly close to getting back into the leading category here at the moment. So you have a fairly broad range here of sectors that are losing momentum here. You have a few sectors that are starting to strengthen here, but I will say, the sectors that are strengthening are the same few sectors that we have seen dragging the markets higher pretty much since, late February. Not a particularly healthy market, in my opinion, at the moment, as what we are seeing right now. I don't particularly have a lot of confidence here in the equity markets with these few sectors leading, because when you just have a couple of sectors dragging the markets higher while the rest of the markets are falling behind, that does not lead to a healthy market rally. Those are some of the same instances that we saw before the coronavirus sell-off. So those are the things that you really have to pay attention to. So the 3 sectors that I think, as you look for opportunities here in this market, which remains firmly bullish, right? There's no doubt about that the current market environment is firmly bullish. So the 3 sectors that are breaking out here are communications, recently breaking out from its recent all-time high. You have real estate, which recently put in a new all-time high here yesterday. And then you have technology also putting in a new all-time high after breaking out from its range. Those are the 3 sectors to pay attention to as you look for upside, while the rest of the 8 sectors are lagging behind. There's no doubt about that. So as we look for opportunities here in this market, what you generally want to find are strong stocks leading the markets higher in strong sectors. So some of the names that we're going to point out here are the names that fall under that category. So the big one from my perspective is Apple from yesterday. Apple has spent the better part of of this past year kind of consolidating from this 140 level here or so. This is a weird looking kind of chart, if you will. It's consolidated for quite some time, broke out, lost a little bit of momentum on this breakout here, and then consolidated for a bit of time and has just started to break out higher here. This certainly starts to project Apple up into the 170, 180 range, because you have this breakout here from 120 to 150. That's about a $30 move. We've consolidated for quite some time. Now we've broken out from 150. So 150 projecting up $30 gets you into the 180 range. So this is really one that's worth paying attention to as you look at the stock market. These are the stocks that are dragging the markets higher. These are the ones that are providing the performance of the S&P and the NASDAQ that are market cap weighted. So when you have big cap stocks like Apple moving, those are the ones that you want to pay attention to. Some of the smaller cap names that are moving are some of the semiconductors right now. You have Broadcom, probably on the back of Apple here, as well as they are providers of 5G chips. You have this recent breakout here above this 495 level. The price action wasn't particularly strong here yesterday. We didn't get a lot of follow through on this particular breakout. So this one could fail and come back in before it continues moving higher here. But it is, in my opinion, a solid breakout. You've had a long move here from 180 to 500. That's a big, almost 300% move. You've had a multi-month consolidation, and we're starting to break out higher here. So this is one that I do think is worth paying attention to, especially for the longer run. And then for a breakout that has perhaps missed, if you will, on the Pfizer breakout when it broke out here from the $40 range. A lot of investors kind of missed out, if you will, on this, a big move here to the upside. Well, we've gotten a pullback here of roughly about 50% below the 21-day moving average. And I think this is a better opportunity to look for further upside here for Pfizer, which has had strong relative strength and looking like it has pretty strong fundamentals. But instead of chasing this stock higher here, wait for the pullback. You've got the pullback now, and this is the opportunity, I think, that for those of you that may have missed out on Pfizer, that you're looking for. And then Tesla has been completing this multi-month bottoming formation. So far, holding the 200-day moving average multiple times as it tests the 200-day moving average, and has multiple kind of bit of false starts, if you will. We had a breakout here above the 700 level, couldn't really sustain it, and traded back towards the 200-day moving average. And now we're making another break higher here around the 730 level here or so. And that will likely put it back towards the 775, 780 highs from April or so. And if we can break above those levels, that's when we start testing 900 or so. So Tesla, after what has been one of the biggest moves here from $80 to 900, that's about 1,000% return. After such a big move, you have to consolidate for some time before it can continue moving higher here. And it's looking like this consolidation pattern is starting to see some life and starting to potentially break out here on a stock like Tesla. You see a similar price action here for Netflix. Netflix has spent pretty much the full year range bound between 580, 570 or so, and this 500 level here or so. And this is after what has been a big move here for Netflix as well. Consolidating for some time, it hasn't broken out from the bigger range here yet. But if you look at within the range, we're starting to see two key levels that I think are important. The 555 level. This was the level that it traded up to the past two earnings announcements and quickly got rejected on both earnings announcements. So big moves here to a key level. The fact that we've now broken back above that level is significant. That projects Netflix back into the 590 range. It very well could fail at that 590 range, but I certainly think that a breakout up to 590 is reasonable. And if it can break out from 590, that's really where you see some significant upside here for Netflix to the upside, especially as perhaps there's some interest now in terms of what Netflix can do in the gaming space. You know, that's probably the largest change that they've seen to their business in probably a decade. There's a little bit of interest in that and whether or not they can really put a dent in that particular space of the world. And then looking at stocks that are on the opposite side of the equation, starting to break down and falling apart. Nordstrom recently reporting earnings and similar type price action to what we've seen in Netflix, going up to earnings recently, trading near the upper bound of the range, and then quickly on earnings breaking down. What's different here about Nordstrom is that after breaking down, it doesn't just hold the bottom end of the range, it's fallen through the bottom end of the range. This is not particularly strong for Nordstrom, especially after this topping formation that this topping formation that has had after what has been a miserable few years. It had this big rally here to the upside, looked like it was starting to show some strength here, but so far looking like this is just the completion of a topping pattern, and the topping pattern has now been complete. This is likely going to drive Nordstrom back. There's a huge vacuum here to the downside into the $24 range, and then as low as into the $12 range here to the downside. So this is one that I think is going to likely see some further downside here for Nordstrom. Looking at IBM, you have a similar type price action here for IBM, but it hasn't broken apart yet. So you have a similar topping pattern here for IBM. This 137 level is the key level as support. And each time it bounces off that support level, as you can see, lower lows. And that's exactly what we're seeing. Lower lows likely to retest this 137. If it breaks below that level, you have the 200-day moving average coming in around 134 or so. If it breaks below that 200-day moving average, there's significantly further downside here for IBM. And keep in mind, IBM is a stock that has underperformed the broader markets for multiple years now. This is not just a recent thing. This is a stock that has shown no relative performance in the markets for many, many years. And what looked like a bit of promise here this year is quickly fizzling out. And that's exactly what my expectation here for further downside from IBM. When we look at Jets, this is really where we see the airlines. Now, one of the reason I'm bringing up this chart is because last week we saw a lot of stocks that were in the travel industry, if you will, show a lot of relative strength. We saw a lot of movement here from Delta, from Southwest, from Airbnb booking. A lot of these stocks were up 5, 6, 7% intraday. But I want to point us to that did not really break us out of the range, right? We have a lot of stocks that have been performing fairly poorly over the past couple of months. And the question was whether if they were starting to ready to break back out here again. And so far, what I have seen from price action across the board from these travel stocks is that no, it has not broken out from this range. It's likely to retest the bottom end of the range. So for those of you that are thinking about getting back into some of these travel stocks, I just don't think we're there yet. The price action does not look favorable just yet, but we are keeping our eye out on that and making sure that we will update you when we start to see these travel stocks break out here again. And then lastly, what I'll leave you with is MasterCard. We've seen a lot of the card players show some weakness. We saw American Express a couple of weeks ago. Visa and MasterCard are both breaking below some support levels. We saw Capital One show some weakness here earlier this week. So the MasterCard, similar type price action to what we've seen here in IBM. It's actually been underperforming the broader markets here pretty much since the early part of this particular year, but recently broke below the 200-day moving average while breaking below this 360 support level here. 360 has been a major support or resistance level for multiple months. Breaking below that and the 200-day moving average, in my opinion, is likely going to put some of these card players back into this 330 level here for MasterCard, but also we see very similar price action from American Express, from Visa, from Capital One, like I said, showing some weakness, not only from an absolute basis, but also on a relative basis to the broader markets. So those are some of the stocks that we currently are paying attention to that are either breaking out to the upside or breaking down to the downside. So quite a bit of movement here in the broader markets here over the past few weeks, despite the fact that the underlying index just continues to grind higher. We are seeing quite a bit of movement on both sides of the market. So hopefully this gives you an update on where the markets currently sit, what sectors are moving, as well as what stocks are moving within the broader markets. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Thursday for our Thursday afternoon session. I hope that this new format is, investors and those of you that are watching today like this new format. We've changed this format to hopefully make this a little easier and a little better for you in terms of experience and finding new opportunities. And we are going to change our Friday rapid fire session format as well to make it a little bit more so that we can actually look at more symbols, new symbols every single time we do a rapid fire session. So please make sure that you submit your symbols for this Friday's rapid fire session. We'll be going through those symbols and only picking out the top stocks out of the ones that you guys pick. So we'll go deeper in the bench and we'll be able to show you a lot more new symbols for that Friday session. With that, thank you so much. I hope you guys have a great trading day.